As we can see in the diagram, a conventional bank treats money as a commodity by pricing the money lent. Hence, in return, it gets a sum of excess money over the principal amount lent initially. Islam does not allow us to treat money as commodity, since it does not have any intrinsic usage. Money has to be converted into a commodity to derive a benefit. Hence, at the same time, Islam allows us to price commodities since they have an intrinsic benefit. Therefore, Islamic banks price and sell commodities rather than lending money, and in return get a selling price which includes the profit amount. Now we will briefly look upon some of the key misconceptions that are prevalent in the market due to lack of understanding in differences at the conceptual, social, business and product implementation level between Islamic banks and conventional banks. One of the common misconceptions is that Islamic banking looks the same as the conventional banking, therefore both are same. It is important to note here that the validity of a transaction does not mainly depend on the end results, but it depends on the steps followed in achieving the end. If the steps and procedure is correct, then the end result is also valid. But if the process is incorrect, the end result would also be invalid. For example, a meat sold in a non-Muslim country and a Muslim country may look and taste the same, but the former is most probably haram, since it does not follow the procedure of Islamic slaughter as ordained by Allah subhanahu wa ta'ala. Another common question that is raised is that a fixed rate of return is not permitted under Shariah. However, it is important to understand that a fixed rate of return merely in itself does not make the transaction halal or haram. Again, it is the underlying process that makes the transaction haram or halal. For instance, if a fixed rate of return is applied by a cotton trader to fix his price, or a fixed rental is agreed by someone renting his house, the return from these transactions will not be impermissible. However, if a fixed rate of return is applied to determine the interest amount in a loan transaction, then the return would be haram. Another most common question raised is regarding the usage of interest rate as a benchmark for Islamic banking products. Since interest rate is only being used as a benchmark for determining profit in an underlying contract which is halal, for instance a sale or a rental transaction, therefore its usage as a benchmark does not make a transaction haram. Just as a business of a juice shop does not become haram by using the pricing of a wine shop, similarly the business of Islamic banking does not become haram by using interest rate as a benchmark. However, if the same benchmark is used for pricing in a loan contract, the profits would be haram. This concludes our introduction to Islamic banking training module. Hope you've learned and enjoyed the presentation. Jazakallah.